Okay, let's dive straight in. Alibaba Group, you've likely heard the name.
Big one.
Today, we're going to try and cut through the noise of their latest financial report.
hmm
We're looking at the March quarter and the full fiscal year 2025 results.
Yeah, there's always a lot in these reports.
Exactly. And our mission here is really to give you someone who wants to be in the know, but maybe doesn't want to drown in data.
Right.
A clear understanding of where this tech giant stands and, importantly, where it seems to be heading.
Absolutely. So we've gone through Alibaba's official earnings announcement, pulled out what we think are the essential takeaways.
Good.
We're focusing on their performance right up to March 31st, 2025. We'll hit the key numbers, the business shifts, basically the stuff that really paints the picture of their current strategy and, their future plans.
So forget wading through pages and pages. We're aiming to be your express route to understanding Alibaba's present and, crucially, their future, especially that user-first AI-driven strategy they keep talking about.
And the AI and cloud growth, yeah, that's definitely a focus area.
Okay, right. Let's get to it then.
Yeah.
What's the headline when we look at the big financial numbers, the overall picture?
Well, the big picture is, I'd say, continued growth, but coupled with a really significant boost in profitability.
Okay.
So revenue for the quarter, it grew by 7% year over year. That's about RMB 236 billion, or roughly US 32.5 billion dollars.
7%. Okay, and the full year.
Full fiscal year, revenue was up 6%, totaling almost RMB 1 trillion, or about US $137 billion. Now look, 6-7% might not sound like, explosive growth.
Right, not shooting the lights out.
No, but it's steady growth, and you have to remember the context. It's a complex global economy right now.
Fair point. Steady is good.
Yeah.
But you mentioned a real jump in profitability. That sounds interesting. Tell us more.
Yeah, absolutely. This is where it gets quite striking. Their income from operations, it just jumps off the page. A massive 93% year-over-year increase for the quarter.
93%. Wow.
Yeah. That hit RMB 28.4 billion, about US $3.9 billion. And over the full fiscal year, the increase was still really impressive, of 24%, reaching almost RMB 141 billion, or US $19.4 billion.
Okay, but a 93% jump in one quarter. What's driving that? Is it just selling more stuff?
Well, not entirely. It's important to unpack that. It's partly due to a rise in their adjusted EBITDA, that's like their operating profit before certain non-cash items,
Okay.
and also a decrease in what they call share-based compensation expense. Basically, spending less on stock options for employees in that specific quarter helped boost that number.
Uh-huh.
And for the full year, a decrease in write-downs of some assets like intangible assets and goodwill also played a big part.
Got it. So some accounting and non-cash factors are definitely boosting that operating income figure.
Yeah.
What about that core operating profit metric you mentioned, the adjusted EBITDA? How did that look?
Adjusted EBITDA also showed, healthy progress. For the quarter, it was up a solid 36% year over year. That's RMB 32.6 billion, or US $4.5 billion.
36% is still very strong.
It is. Though for the full fiscal year, the growth was slower at 5%. That came in at RMB 173 billion, or nearly US $24 billion.
And what did they say caused that growth?
They put it down to, well, making more money from sales, obviously, and also just running things more efficiently, better operating efficiency.
Makes sense.
Although they did also mention they increased investments in certain areas, and that offset some of the gains.
Right, so they're spending to grow, investing, but also getting better at managing the core business to squeeze out more profit. Seems like a decent balance.
Yeah, that seems to be the story.
Now, net income, that saw a truly enormous percentage increase, didn't it? Something like over 1,000%.
It did, yeah. The number is staggering. Net income was up 1,203% year over year for the quarter,
1,200%.
reaching about RMB 12 billion, or US $1.65 billion. And for the full fiscal year, it was still a very substantial 77% increase, hitting almost RMB 126 billion, or US $17.4 billion.
Okay, but numbers like 1,200%.
It's
So
right.
that's to be something unusual there, right?
Exactly. You always need to look under the hood with figures like that. And it's crucial to understand this dramatic surge is largely due to mark-to-market changes, basically how the value of their investments in other companies fluctuated.
Huh. So it changes the value of their stock portfolio, essentially.
Pretty much. That plus the increased operating income we already talked about, and also fewer write-downs on some of their other investment holdings compared to last year.
Okay. So while that massive net income growth grabs headlines, it's heavily influenced by their investment performance, not just the core operations. Good to clarify.
Definitely.
What about things that directly benefit shareholders, like capital returns, share buybacks, dividends, and their cash situation?
Yeah, on the shareholder return front, they've been pretty active. In fiscal 2025, they bought back a significant amount of their own shares, US $11.9 billion worth.
That's quite a bit.
It is, think of it like reducing the number of slices in the pie, potentially making each remaining slice more valuable. This led to a 5.1% net reduction in their outstanding shares.
Okay, and dividends.
On top of the buybacks, yes, they've approved dividends totaling US $4.6 billion for the fiscal year. That includes both a regular annual dividend and a special one-off dividend.
A special dividend, too. Interesting.
Yeah. Specifically, it works out to US dollars 35 cents per ordinary share or US $2 per ADS. ADS is the American Depository Share, which is how many international investors hold Alibaba stock.
Right. Any key dates people should know?
Yep. The record date, that's who's eligible, is June 12th. Payments are expected around July 3rd for the ordinary shares and July 10th for ADS holders.
Okay, so a significant amount of cash flowing back to investors through both buybacks and dividends. Now, what about their free cash flow? That actually saw a big drop, didn't it?
It did, yeah. That's the other side of the coin.
Ugh.
Free cash, the cash they generate after covering operating costs and capital spending, decreased by a pretty notable 76% for the quarter.
76% decrease.
Wow. Landing at about RMB 3.7 billion, or just over half a billion US dollars. And for the full fiscal year, it was down 53%, totaling around RMB 74 billion, or just over US $10 billion.
And what's the reason for such a sharp drop?
The main driver, according to their report, is increased spending on capital expenditures, specifically building out their cloud computing infrastructure.
Ah, okay.
Yeah.
So they're making big investments in the nuts and bolts of their cloud business, and that's hitting the immediate cash flow.
Exactly. It makes sense strategically given how much they're emphasizing cloud and AI as future growth areas. But yeah, it impacts the cash flow in the short term.
Right. Big investments today for hopefully bigger returns tomorrow. Okay, that covers the overall financials. Let's maybe pivot now to how their individual business segments performed, starting with the core, the big one, Taobao and Tmall Group.
Sure. So Taobao and Tmall, their main China e-commerce platforms, showed pretty solid performance. Their customer management revenue, which is a really key metric reflecting how well they monetize traffic.
Like advertising and commissions, right?
Exactly. That grew by 12% in the quarter, reaching RMB 71 billion, or nearly US $9.8 billion. And for the full fiscal year, it was up 6%, totaling RMB 322 billion, or US $44.4 billion.
And what drove that growth? Just more people buying things.
It was primarily fueled by what they call an improved take rate.
Take rate. Okay, can you break that down for us? What does that mean in this context?
Yeah, sure. Think of the take rate as sort of the commission percentage. It's the slice of the total value of transactions happening on their platforms that Alibaba actually gets to keep as revenue.
Got it.
And this increase in their take rate was driven by a couple of things they highlighted. Firstly, the software service fees that merchants pay to use certain platform tools and features. And secondly, growing adoption of something called Quanzantui.
Quanzantui. What's that?
It seems to be essentially a suite of marketing tools. Helps merchants on Taobao and Tmall target customers more effectively, run campaigns, that sort of thing. So Alibaba earns more from offering these value-added services.
Interesting. So it's not just about the volume of sales, but also getting a slightly bigger piece of each sale and selling more services to the sellers.
Precisely. It shows they're finding ways to monetize their platform beyond just basic transaction fees.
What else stood out for Taobao and Tmall?
Well, they've clearly been investing quite a bit in the user experience and other strategic initiatives. Things like offering more price-competitive products, improving customer service, enhancing their membership program, the 88 VIP program, and also increasingly weaving AI into the shopping experience itself.
And are these investments paying off?
It seems so. They reported growth in new customers and also an increase in the number of orders being placed. And that 88 VIP loyalty program you mentioned, it apparently surpassed 50 million members.
50 million, that's substantial.
Yeah, and they said it saw double-digit percentage growth year over year. So that suggests they're doing a good job of keeping their most valuable customers engaged.
Okay, so it sounds like a focus on both attracting new shoppers with competitive prices and better service, but also really locking in those loyal, high-value customers.
That seems to be the strategy, yeah.
Right, let's switch gears then. Let's talk about their international arm. The Alibaba International Digital Commerce Group, or ADC, they've been posting some pretty impressive growth numbers lately.
They really have. ADC reported robust 22% revenue growth in the quarter. That reached RMB 33.6 billion, roughly US $4.6 billion.
22% is strong.
And even better, for the full fiscal year, 29% growth, totaling RMB 132 billion or over US $18 billion.
Wow. And what's driving that international growth?
Primarily, they're cross-border e-commerce businesses. Specifically, they called out AliExpress and Trendyol.
AliExpress, right? We hear a lot about their choice service. And Trendyol, that's big in Turkey and the region, isn't it?
Exactly. Those seem to be the main engines for ADC right now.
What about the financial picture beyond just revenue for ADC? Because expanding globally, that can be expensive, right? Are they profitable yet?
No, ADC is still operating at a loss overall, but the good news for them is that they managed to significantly narrow that loss compared to the previous year.
Okay, so moving in the right direction at least.
Yeah, they attributed this improvement to better operational efficiency and smarter investments, particularly within that AliExpress choice business you mentioned, the one focused on curated products and faster shipping.
Right.
They also mentioned they're strategically focusing their efforts, not trying to be everywhere at once, but concentrating on key markets like certain countries in Europe and also the Gulf region.
And tailoring their approach for those markets.
Yeah, adapting their product offerings and business models to fit local consumer needs better.
Okay, so it seems like that international bet is starting to show results. Strong growth, improving efficiency, clearer focus, good signs.
Definitely.
Now let's move to a segment that's generating a lot of buzz lately, especially given the whole AI narrative. The Cloud Intelligence Group. How did they perform?
Right, Cloud Intelligence. They also delivered a strong showing. Revenue increased by 18% in the quarter.
18%. That's a nice acceleration.
It is. It hit RMB 30 billion, or about US $4.15 billion. And for the full fiscal year, growth was 11%, reaching RMB 118 billion, or US $16.3 billion.
And what's behind that quarterly acceleration?
What's particularly noteworthy there is the acceleration specifically in their public cloud revenue growth. And that, they said, was significantly fueled by customers adopting their AI products and services.
So the AI hype is translating into actual cloud revenue.
It appears so. In fact, they highlighted that their AI-related product revenue achieved triple-digit year-over-year growth.
Triple-digit. Again.
Yeah, for the 7th consecutive quarter.
Wow. Okay. That's not just hype then. That's sustained rapid growth in AI services.
Seems like it.
Which industries are particularly keen on adopting these AI solutions from Alibaba Cloud?
They mentioned pretty broad adoption across different sectors, internet companies obviously, but also retail, manufacturing, and media. The focus seems to be shifting towards AI applications that provide, tangible business value.
Right, practical applications.
Exactly. A prime example they highlighted was Lingma. That's their AI coding assistant.
An AI pair programmer, basically.
Sort of, yeah. Helps developers write code more efficiently. Apparently, it's seen really strong uptake among enterprise clients and is generating significant revenue growth for them already.
That makes sense. A tool that directly boosts developer productivity, you can see the appeal for businesses.
And it seems their overall AI capabilities are getting noticed, too.
How so?
Well, Gartner, the tech research firm, recognized Alibaba Cloud as an emerging leader in all 4 key areas of generative AI in a recent report.
All 4? What areas are those?
Things like the underlying AI models themselves, the engineering platforms to build AI applications, the specialized cloud infrastructure needed to run these demanding AI workloads, and also AI knowledge management tools.
Okay, so broad recognition across the Gen AI stack.
Pretty much. And they're not standing still either. They're actively pushing the boundaries. Just back in April, they launched their new Qwen 3 series of multimodal AI models.
Qwen 3. Multimodal means it can handle text, images, maybe audio.
Exactly. Text, images, code. These models are getting very versatile. The Qwen 3 series includes a range of models with different sizes and capabilities.
Tell me about the flagship.
Their flagship is a mixture of experts, or MOE model. Think of it like having a team of specialized AIs working together. It's called Qwen 3 235B A22B. Huge number of parameters, 255 billion.
Wow.
But it only activates a subset, about 22 billion, at any one time. The idea is to get really high performance in complex tasks like coding, math, reasoning, but do it more efficiently than a single massive model.
Clever. Balancing power and efficiency.
Yeah. And they've also released smaller, more accessible models in the Qwen 3 series. Importantly, they've made all of these models open source.
Open source, even the big one.
Yep. Available on platforms like ModelScope and Hugging Face. It's a pretty big deal. Allows researchers and businesses everywhere to use and build on Alibaba's AI work.
That is a bold move. Could really spur innovation. Okay, so cloud and AI clearly firing on multiple cylinders. Let's briefly touch on some of the other business segments. How did Cainiao, their logistics arm, do?
Cainiao, right, their logistics network. It actually saw a revenue decrease in the quarter, down 12%.
Oh, really? Why is that?
Settled at about RMB 21.6 billion, or just under US $3 billion. The dip, they explained, is largely due to how logistics functions are increasingly being integrated directly within Alibaba's main e-commerce operations rather than being treated as a completely separate service transaction.
Ah, so an internal shift affecting the reported revenue.
Seems like it. For the full fiscal year, though, revenue was actually up slightly by 2%, reaching RMB 101 billion or almost US $14 billion.
And profitability for Cainiao.
They did manage to narrow their losses during the quarter, but that was partly due to some one-off retention incentives related to the withdrawal of their IPO plans last year.
Right, I remember they pulled the IPO. Okay, so a bit of a complex picture for Cainiao. Seems like it's in a transitional phase, being more tightly integrated, but maybe some underlying improvement too.
Yeah, that sounds about right.
What about their local services group? This includes things like Ayla.me food delivery and AMAP navigation.
Correct. Local services actually showed some positive momentum. Revenue grew 10% in the quarter to RMB 16.1 billion or US $2.2 billion, and 12% for the full fiscal year, reaching RMB 67 billion or US $9.2 billion.
What drove that growth?
Mainly growth in order volume on both AMAP and Ella.me, people using the mapping and delivery services more, plus growth in marketing services they sell to local businesses on those platforms.
And are they making money yet? Local services can be tough.
Still loss-making overall, but encouragingly, they said their losses continued to shrink. That's thanks to achieving greater scale, more orders, and improving the unit economics, meaning they're getting more efficient with each delivery or transaction.
Good to see progress towards profitability there. And finally, briefly, the digital media and entertainment group, Youku Streaming, movies.
That segment also saw revenue growth, up 12% in the quarter to RMB 5.5 billion or US $765 million, and 5% for the full fiscal year, hitting RMB 22 billion or US $3 billion. Mainly their movie and other entertainment businesses, plus better advertising revenue for the Youku video streaming platform.
Okay.
And actually, a significant highlight here. The adjusted EBITDA for this entertainment group turned positive in the quarter.
Profitable, finally.
Largely thanks to Youku itself finally reaching profitability, yes. That's been a long road for them.
Indeed. Okay, so across the board, it's a mix, but generally seeing growth and, in many cases, improving efficiency or profitability in the individual units. Let's zoom back out then and look at overall costs and expenses. Any major trends there?
Yeah, a few things stand out. Firstly, their cost of revenue, what it costs them to generate their sales, actually decreased as a percentage of their total revenue for both the quarter and the full year.
Why was that?
Mainly due to doing less direct sales activity themselves, where they own the inventory, which has lower margins, and also just improved efficiency in their platform operations.
Okay, but did any costs go up?
Yes. Their sales and marketing expenses, as a percentage of revenue, did increase. That reflects those investments we talked about, trying to grow their e-commerce businesses in a competitive market.
Makes sense. You have to spend money to make money, especially in e-commerce. Now, one area that saw a really big change was share-based compensation, right? The cost of stock options for employees.
That's right. That expense saw a substantial decrease for both the quarter and the fiscal year.
And the reason?
Primarily because they granted fewer new stock awards. They seem to be shifting more towards using long-term cash incentives instead of just stock.
Interesting shift.
Yeah. The report also breaks it down by who got the awards: Alibaba Group employees, Ant Group employees, others. And it mentions that a revaluation of their investment in Ant Group in the previous fiscal year also made the year-over-year comparison look particularly favorable this year.
Got it. So fewer new grants, more cash incentives, and maybe some favorable comparisons to last year. What about things like amortization and impairment? Writing down the value of assets.
That also showed a substantial decrease, particularly for the full year comparison. A key reason for that was a very large write-down they took in the previous fiscal year related to their Sun Art retail business.
The supermarket chain.
Right. Because they took that big hit last year, it makes this year's figures for amortization and impairment look much lower by comparison. It flatters the current year's results a bit.
Okay, that's important context. So when we piece all this together, the performance of the different businesses, the cost trends, the investments, What does it really tell us about Alibaba's main strategic priorities right now? Where are they focusing?
Well, the overall picture, I think, really reinforces that user-first AI-driven strategy their CEO keeps emphasizing.
Hmm.
You see a very clear focus on investing in their core e-commerce operations, trying to improve user experience, offer competitive prices, but also very significant investment in key technologies, especially AI and cloud computing.
Trying to build that competitive edge for the future.
Yeah, exactly, and drive future growth. The rapid progress we saw in the cloud intelligence group, particularly around AI,
Yeah.
it really positions that segment as a potential major new growth engine for the whole company long term.
And alongside that tech investment, they're also clearly committed to returning value to shareholders,
Right.
right? Through those big buybacks and the dividends.
Precisely. They made it pretty clear that enhancing shareholder returns is a key part of their current strategy. It's not just about growth at all costs anymore.
Right. It's growth plus returns.
Yeah, it seems like a more balanced approach, perhaps.
Okay, so let's try and wrap up this deep dive into Alibaba's latest results. To recap, we've seen uh, consistent overall revenue growth, maybe not spectacular, but steady,
Hmm.
but also significant improvements in profitability, driven partly by strategic investments paying off, partly by greater operational efficiencies.
Right, and some helpful accounting factors, too.
True. Particularly strong performance, it seems, within their cloud and international commerce segments. Their commitment to AI is undeniable, and it's generating really impressive growth figures in the cloud business.
Triple digits for 7 quarters running. That's hard to ignore.
Absolutely. And at the same time, they're taking concrete steps to return billions of dollars to their investors via buybacks and dividends. So for you, our listener, we hope this has given you a clear, comprehensive understanding of where Alibaba stands today and its strategic direction. The key insights without getting totally lost in the weeds.
Yeah, hopefully cutting through some of that complexity. And as we think about all this, Alibaba's huge investment in AI, its rapid advancements there, combined with this vast ecosystem they have, e-commerce, cloud, logistics, payments, entertainment. It really prompts a fascinating question, doesn't it?
Go on.
What are the potential long-term impacts? I mean, what profound and lasting effects might this AI-driven strategy have on the global digital landscape over the next, say, 5 or 10 years?
Right. How could it reshape things beyond just Alibaba itself?
Exactly. How might it fundamentally alter not just their own businesses, but maybe consumer experiences more broadly? Or how other businesses operate well beyond just e-commerce and cloud as we know them today? It feels like a really significant shift is underway.
A very provocative thought to end on. What does an AI-driven Alibaba mean for the rest of the digital world? Something definitely worth watching.
For sure. Lots to keep an eye on there.